Deferred tax. Next, let us discuss deferred taxes. What do you understand by deferred taxes, students? Sometimes the tax we think we should pay as per the accounting profit computed in our books may be different from what the tax authorities say. That gives rise to a deferred tax. It does not mean that we will not pay the tax. We feel we have paid more, we feel we have paid less. It will be adjusted in the future years. As a result, because we think our liability is different from what the income tax authorities ask for, there is a deferred tax asset or a deferred tax liability. Let us slowly try to understand what deferred tax is, why it comes about, and when does deferred tax occur. Now, accounting profit is computed as per accounting standards. Yes or no? We compute accounting profits as per accounting standards. We are following US GAAP. Every country follows its own accounting standards. So here in this case, we are talking about US GAAP, right? So we make books of accounts, we prepare an income statement, and we arrive at a net income, a taxable income. We have computed profit. But as per the tax laws, as per the Internal Revenue Code of the IRS, right, the profit may be slightly different, They may not allow some expenses to be deducted. They may want to take more income in the current year. It can be slightly different. Over a period of time, all these differences would get sorted because these are temporary differences which vary from year to year. So since the profit, accounting profit, and that is net income and the taxable income can be different because of the difference in timings of revenue and expenses. So what happens? We get either a deferred tax asset or a deferred tax liability. Followed? So the deferred tax asset or liability, when do you get an asset, when do you get a liability, we'll come to briefly. Just try and understand. Because the net income, the accounting profit as per our financial books may be different from the taxable income computed by the tax authorities, by the IRS, there could be a difference, and as a result of these difference in timings of revenues and expenses, we get a deferred tax asset or a deferred tax liability. A deferred tax asset is similar to a prepaid tax, and a deferred tax liability is nothing but outstanding tax. What is prepaid tax? We don't think so much of tax should be paid. As per our books, the tax is less, but as per tax authorities, we have to pay more. So we end up paying, we record what we have paid as prepaid tax, not as a tax expense. Followed? Similarly, if in our books we see, we need to pay more tax. Tax is more as per our financial books, but the tax authorities have taken less tax. It means as per our books, we have an outstanding tax. We have a liability to pay tax. Mind you, this arises only if the differences are temporary. They will get sorted out over a period of time. Why does this happen, students? A simple example is sometimes we may be, if we take a rate of depreciation, we may be using a straight line method. The tax authorities may allow only for an accelerated rate of depreciation. In that case, what happens? In the beginning years, the total depreciation finally over a period of 5 years, 8 years or 10 years may work out to be the same. But in the initial years, the depreciation here will be low, profits will be higher, and taxes will be higher as per our books. But here depreciation will be higher, therefore profit will be low, and therefore taxes will be low under this. I repeat, over a period of the entire lifespan of the asset, the total depreciation would be the same, whether it's this or that. So it will get sorted out over a period of time. That is why this is effective. This deferred tax asset and deferred tax liability exist only when the differences are temporary. If there are permanent differences, they are of course not a deferred tax asset or liability, because we will not have a liability to pay the tax in future, nor will we have prepaid any asset. There will neither be any deferred tax asset or deferred tax liability. Let us look at some of the reasons. In financial reporting, we use accrual basis to report revenue, but tax reporting, they use a modified cash basis. For example, if we get advance income, we get income in advance for a project to be completed next year, then what will happen? That the income tax authorities will take it as income in the current year, therefore profit will go up and therefore taxes will go up. But we say this is, we follow an accrual basis in the financial books, and therefore in our financial books we will not report this as an income, and therefore our profits will be low. Of course, what will happen next year? Next year we will take the same thing as income, but next year tax will not have an income. Therefore, over the period of 2 years or whatever the time period, it will get adjusted. The differences will even out. But there is a temporary difference between, say, year 1 and year 2. This is one of the reasons. Estimated liability for warranties and pending litigation is allowed. We have something, we make a provision for warranties. We can make a provision for warranties, but under tax reporting, estimated liability, such provision, after all it's only an estimation, it is not allowed. The amounts, expenses have to be actually incurred, only then it would be allowed as an expense. When straight line method of depreciation is used, depreciation is lower in the early years. This is what I was mentioning before. Depreciation is lower in the earlier years. Therefore, pre-tax financial income is higher. Therefore, as per our books, tax is high. But here, accelerated depreciation methods are used. Depreciation is greater when in the early years. So, there is a lower taxable income in the early years of the life of the asset. Of course, it will peter down, and in the later years, there will be less depreciation here, therefore higher profits here, and reverse the case in under financial reporting. Follow. These are some of the reasons why there is a difference in the profits as per financial reporting and tax reporting, and therefore there is a difference in the income taxes which are actually payable as per income tax authorities and are what we think as per our financial books is the tax expense. To summarize, actually, when do we have deferred tax? When the revenues are taxable before book recognition. When revenues are taxable before book, we do not recognize in the books, but they are recognized as income in tax. Like I said, unearned income. We've got income received in advance. This will become, they are taxable before book recognition. We will recognize only next year. Tax authorities recognize in the current year. Or when revenues are taxable, after book recognition. Usually, what happens is, say there are sometimes tax-free bonds. Tax-free bonds, the income from these bonds is not subject to income tax, but we may include it as a part of our net income. However, such a difference is frankly not a temporary difference, it is a permanent difference. But if there are situations where revenues are taxable after the book recognition, then again we would have deferred tax. Similarly, when expenses are tax deductible before book recognition, like I said, accelerated depreciation under the tax rules, so they become deductible. I have not recognized so much depreciation in my books, but the tax authorities have already done. On the other hand, when tax expenses are tax deductible only after book recognition, like creating a provision for doubtful debts, we create an estimate. It is not allowed, but here we have taken it as an expense. It's already recognized, but here it will be recognized under tax. It will be recognized only when actual bad debts occur. When do you have a deferred tax asset? When taxable income as per government is more. Right? The taxable income is more. So what happens? The taxes required to be paid is more, taxable income is more, taxes required to be more, required to be paid is more, tax payable is more. So we end up paying taxes, more taxes. In our books there is not so much of an expense. Therefore, this becomes a prepaid tax, and that is a deferred tax asset. Prepaid expenses are assets. Correct? Is it clear, students? So taxable income as per the government is more. That means taxes required to be paid is more. In our books it is less. That means we will have to pay it. We will pay what the income tax authorities have asked us to pay. Therefore we pay it as per the IRC. But according to our books, so much of tax liability we don't have. We have paid more tax than required to be paid. Therefore, that is a prepaid tax. We are required to pay more than as per our financial books. So when do you have a deferred tax liability? When accounting profit is more. Right? We have more profit, and therefore when taxes which is required to be paid as per IRC, right, according to the IRS is less than the taxes as per the financial books. Is it clear? So what will happen? These taxes will have to be paid in future. That means we pay less than what we are willing to pay. We actually pay less. We feel we should be paying more. Therefore, we end up with a liability. Right? That is why liability, that is a deferred tax liability. This is a deferred tax asset. Is it clear? So taxable income, if it is more, as per tax authorities, if the income is more, they charge more tax, we end up paying more tax. Therefore, it's an asset because we have paid for the future. But on the other hand, if our accounting profit is more, we feel we should pay more tax. But the IRS wants much less tax. Therefore, we have a liability in our books to pay that tax. Okay.